Not as much. My hip has given me some agitation.
That's it.
So.
What, from the running?
Well, pretty much, yeah. So I'm just trying to manage my load through golf season, and then we'll give it another crack when the autumn comes.
When you hit your 50s is what happens.
Oh, Hughesy. Hughesy.
How old are you?
No, I'm not 50. I'm still well in my 40s.
Low 40s.
My low 40s, thank you. Yes. Yes.
Very good.
How about you? Your lunch has been cancelled.
Lunch has been cancelled. So I'm racing tonight actually at Hillingdon.
On the track.
Well, it's closed road circuit, but ultimately it's kind of a sort of track, yeah.
Good.
So that starts at 7. So I've got to get back home promptly, sort out the bike. I'll probably ride there actually. Nice weather.
It's going to be hot again. Back in the 30s.
And then I'm sure our listeners would have missed it, but I'm off on holiday on Sunday.
No way. I can't believe you're off on holiday. Who'd have thought it?
For 2 weeks to Cyprus.
Oh, lovely.
Yeah.
That'll be hot.
So same hotel as the last 5 years.
Yeah.
We're really, the kids are knackered.
Was it the Olympic resort or something? The Mount Olympic? Almera. There we are. If anyone's in Cyprus in the next 2 weeks, go and drop in on
Come
Hughesy.
and say hello.
Right, well, let's get cracking because we're all busy people. Hello, everyone, and welcome to Taking Stock After the Bell, episode 68, the second episode we're recording this week, in fact. But unfortunately, no guest today, just Hugh, well, apart from Hughesy, but take that as it may. And as has now become tradition at the end of quarters or half years, we thought we'd do a little run through of what's going on in markets because it's fair to say there have been numerous talking points, which we've obviously discussed on the pod on the way through, but always quite nice to see where we are. But good quarter, good 6 months, Hughesy. What's your overriding feeling?
It's been, I mean, performance-wise, it's been really good, hasn't it?
Absolutely.
Yeah. Asset classes have returned really well. I think there's not really been any regions that have struggled per se, but and then in the background there's been some uncomfortable periods of lots of volatility, whether it's driven by the Iranian conflict or kind of issues with semis or tech excitement, Trump's various announcements on Truth Social, which, I mean, it's quite extraordinary, really, what has happened over the last few months. And then, as you say, new government coming in potentially, not a change in party, but
not a change of party, but new leadership,
new leader, new chancellor.
Yeah, well, we assume new chancellor. It might not be.
Well, we'll see.
But depending on the scheduled releases, if you want a deep dive on the UK, go and listen to episode 67 with Callum, which I very much enjoyed. But
and the other thing as well is you've had, I mean, something like gold, which we'll get onto. I mean, the volatility has been extraordinary, really.
Yeah. Well, volatility everywhere has been wild, but ultimately it's been pretty lucrative. So we'll do the first chart 2, Alex. Asset class performance, 6 months of the year to date. MSCI All Country World Index, global equities up 13%, the yellow line. UK equities up 7.1%. Hedge fund index, HFRX, is up 4.6%. And then bonds basically flat, gilts up 1%. Corporate bonds up 1% and gilts flat. Which is fine, isn't it, for 6 months? Equities average annual return 10%, 8 to 10%. So you've got 13% in 6 months. That's pretty good. You can see the drawdown in March. Following the UK had a very strong first 2 months. The UK was up 10% the first 2 months, and then it gave it all back pretty much. But the UK, I mean, during the last 2 months, April, May, and June, the UK equity market has flatlined compared to global equities, which has been on a bit of a tear in comparison.
Which is quite strange in a way, based on what the oil price had been doing. You would have thought you'd have had a bit more from.
Well, the oil price has come down, hasn't it? Which is why the UK market's flatlined, because obviously BP and Shell are now 10% of the index, so they will have dragged the index down a little bit.
But if you look at where the conflict started,
end of February,
you would have thought
the UK market would have done better. Yes. Well, as we will have discussed before, the UK market's got zero exposure to technology, or maybe 1%, and that exposure is mainly software, which has been hit anyway.
I think. Yeah, I don't think gilts returning 0 would have been on my bingo card in January. I thought gilts looked very attractive based on
4.5% yields.
Yeah, exactly. But obviously, there's been some there's been a change in expectations in terms of interest rates.
Well, we'll come on to that because I've made that chart. Don't you worry.
You are.
I'm so proud of that chart. But anyway, I think probably the biggest story of the first 3 months was the conflict in Iran, and we've got a couple of charts here of crude oil. This goes back 5 years on the left, and then UK natural gas prices on the right. And whilst the oil price spike looks not dissimilar to the Russia-Ukraine outbreak, where it goes from 70s to 120-ish at the peak, and it's come right back down, the UK natural gas price looks like barely a move in comparison, with not really having a huge amount of impact. So I think as we've talked before, the sort of initial PTSD of many of us in the UK fearing a rerun of 2022 is not quite the same, because the UK gas price, which does determine our marginal cost of electricity here, has not moved in the same way. But I think that the rise in the oil price was one thing, but the fall in the oil price on the other side of it is probably as extraordinary, isn't it?
I think based on oil not flowing anything like what it was doing before the conflict. And we're virtually, we're not back to where we were, but we're only $10 a barrel higher than it, aren't we?
Well, I think we're down to 70 today, so we're pretty much where we were on the eve. But yeah, you're right.
I mean, the world stepped up in a way in terms of utilising reserves. And China in particular really, really lent into theirs and supplied. Although, if they're supplying at a much higher oil price and now they're buying back their reserves at 70
What a trade.
That's not a bad trade.
What a trade.
I know.
Yeah.
But in another way, on the other side, there was way more disruption to oil this time round than there was in 22, but the oil price didn't actually reach the same peaks, did it?
No, there's mitigating factors that, we discussed probably back in April when it all kicked off. China stopped importing. Strategic reserves releases from the likes of the US and Japan in particular, and then workarounds. So you had pipelines filling up some of the gap of the oil that was coming out of the Strait.
More movement through the Red Sea and things like that.
Exactly. You had enough mitigating factors to mean that, most oil analysts prior to the conflict, had you asked them what would happen if the Strait of Hormuz was shut for 3 months, 4 months, whatever we're on now, they would have said $250 a barrel, Armageddon, Black Swan, everything is off, and that didn't come to pass. So that's probably one of the most interesting stories.
I think the other thing is as well, when the conflict kicked off, if you looked at future pricing of oil, it was pretty low for 3 and 6 months.
Yeah.
But that's very much based on the conflict ending and the Strait completely reopening. And it hasn't completely reopened, but actually the pricing has fallen further than where those future prices were. So oil experts have had a really tough time because they just didn't predict the oil price coming back as quickly as it has done.
I think it comes back to when people clients ask me, why have portfolios done so well? I kind of keep coming back to this idea of humans, companies, people, governments who are being quite agile and much more flexible than they used to be.
Yeah.
Like tariffs. If you're a company, how do you navigate tariffs? Well, you move supply around, you make mitigating factors. The pandemic, we were all sent home. I mean, and the world kept turning because we managed to adapt quite quickly. And I think maybe people in the medium to long term underestimate the adaptability of the economy in general and companies specifically.
Yeah, I would have thought oil is the one, and oil being moved physically, that would be the one that had the most trouble. But actually, Saudi's pipeline was utilised a lot more. We've already mentioned the Red Sea movement, release of strategic reserves. It's quite amazing what was done. I just hope that those reserves are refilled, because we've had 2 serious oil conflicts now in a number of years. Hopefully the UK's learned its lesson.
We need to build some more reserves into the system, don't we? And that is, we've talked about that multiple times over the years about how the world has changed, and we need to be a bit more ready for problems in terms of supply chains and commodities, etc. So we'll see if the government get that memo. But a couple of charts on macro, which you're not going to dwell too long on this, but inflation, UK here is a blue line, down to 2.8% from slightly higher at the start of the year. Yep. The US number has jumped up, but gasoline, petrol prices in the US have a bigger, more immediate impact on US CPI. So that number's gone up to 4.2, but that's likely to unwind next month because when we have US CPI, it's probably next week or the week after. But UK inflation was set to fall quite meaningfully, and actually it's got a little bit stuck at 2.8. And then this is the chart that I'm most proud of. So this is UK base rate, the blue line here, which obviously sits at 3.75 today and has been for nearly a year now. On the 20th of February, the green dotted lines here, the market was expecting rates to fall throughout 2026 and into 2027. So the market was expecting a few more cuts down to 3.25. At the height of the crisis in Iran on the 20th of March, the market was expecting rate hikes.
When we were expecting 4 at one stage.
4 rate hikes. And I think I may have said that I would
you did.
hat if we were going to have 4 rate hikes. We haven't had 4 rate hikes. So the market expectations today is that middle line, the blue line. The market is still expecting 1 rate hike this year. I think September or November is when it's priced.
I'm not sure that's going to happen.
I'm not sure it's going to happen either, but it's just fascinating how the market's gone from rate cuts to lots of rate hikes to 1 rate hike in the space of 6 months, and that oil price impact is, Callum had the chart, didn't he, with the number of rate hikes priced in versus oil price.
And Callum did mention it in 22 before the Ukrainian-Russia conflict and the oil price spike. The Bank of England was expecting inflation of 7% because of supply side issues from COVID. That is a very different environment to where we are today. I mean, we were expecting inflation to fall bar this event, but also the economy is in a different place. I think you've got recessionary concerns and real growth concerns where we are today. I think that trumps an inflation issue. I think they look through the inflation because it is a short-term issue. So actually raising rates will just curtail growth even more. It doesn't need to be done.
Counterproductive in my view.
Totally.
Yeah. And then on that, we do have the unemployment rates here. Blue line, the UK, 4.9%. Come down a bit, actually, because it was going up. And then the US at 4.3.
Yeah, because they had that big revision, didn't they? Or that unexpected number last month.
Yeah, in the UK. Yeah, well, the UK data is a bit of a mess because the Office of National Statistics has said that it's basically untrustworthy at the moment because they can't seem to collect the data properly.
Because of the old-fashioned way of collecting survey data.
Doesn't work anymore.
No.
Yeah, so there's a sort of big question mark over the UK labour market data, but in the aggregate, it's pretty weak and unemployment is higher than it was. But it's not getting worse for the time being, so that's good news. Maybe that continues. We've got US labour market data today, it's a Thursday, which is a bit unusual, but tomorrow is the 4th of July, isn't it?
It is.
4th of July celebration, holiday. So, yeah, the UK economy, we're not going to dwell on it. US economy looks very strong, actually, and I haven't got any more charts on the US economy, but we were just discussing it in our investment meeting, our monthly meeting. Retail sales strong, all the manufacturing PMIs strong. Labour market seems to be re-accelerating. And, if there's going to be rate hikes anywhere, it's more likely to be in the States, I would have said, than the UK.
Yeah, agreed.
We shall have to wait and see.
And that's probably why you've got, well, we'll see later on, but you've got things like gold.
And the dollar's going up, and the gold's going down.
Yeah, you've had a big effect on those asset classes because of potential rate hikes.
Someone said to me that sterling has done very well against the euro recently. Yeah, back down, whichever way some people have a different way of expressing, oh yeah, that's right. So pound against the euro, it's 85.5 pence compared to 87, nearly 90 pence at the end of last year. So sterling has got a bit stronger against the euro in particular, sort of flatline against the dollar, but
despite our
it's interesting
domestic issues.
Well, yeah, exactly. Well-trialed domestic issues. And then government bond yields, year to date, they are higher, yes. And the blue line here is the UK, chart 7, Alex. And it is a 5-year chart, but you can see on the right-hand side, they have gone up since the war started. Well, when the war started, they went up, and then they've come back down a little bit. The UK 10-year got over 5% in the midst of March.
Yeah.
When it was at its worst. Again, look at that red line there, the Japanese government bond yields continue to grind higher, don't they?
Yeah.
They've got a lot of debt that they need to service. So, as Callum really said on Tuesday, the prize for the UK government is some credibility on the fiscal side.
Yeah.
And UK yields come back down below the US yields, which is where they normally are.
Yeah.
So that would be a sort of 50 to 100 basis points, 0.5 to 1% fall in UK yields, which gives the Chancellor quite a lot more room, because we are talking billions in interest costs here. Where this isn't a few, it's not a few quid. This is quite meaningful. So,
and do you think that's something the Bank of England take into account as well?
Yes, I think they do. I think they do. But then,
but if we don't have a rate hike again this year, then you might see that 10-year dropping off a bit further.
You might do, but the flip side of that is that the market is as worried about inflation in the UK as they are about the fiscal. So the Bank of England need to deal with the inflation problem if there is one.
Yeah.
Which might give them some more credibility again at the longer end of the bond market. If that sort of makes sense.
I think it. Although we think it's probably higher for longer, I do think as an entry point, 4.5% is quite an attractive risk-free rate.
I agree, and I agree on both sides of that. I think we are in a world where inflation is higher and more volatile, clearly, and we seem to be getting these supply chain problems and spikes in inflation. But you can still look at the UK 10-year at 4 3/4 and say that's quite an attractive rate of return. So, I don't know, really. Those two things aren't mutually exclusive, are they?
No.
And then credit spreads, a credit spread is basically the additional return you get from lending your money to a company instead of a government. So if I was going to buy a bond in HSBC or BP or Glaxo, I might expect them to pay me more than the UK government because they might not pay me back. So that is the spread here in blue. And it's fair to say that spreads are tight, i.e. you're not getting much extra return from lending your money to companies over the government. But you are still getting 1%, so you're getting nearly 5.5-6% on UK corporate bonds, which is a nice all-in yield.
Yeah, particularly where some of their balance sheets look slightly stronger than the UK's government.
You could argue that companies look relatively stronger. Yeah, no, agreed.
But actually, with what's been going on, spreads have remained remarkably tight. You would have expected there to be some movement there.
Yep.
So, I guess it's saying the bond market's relatively happy, isn't it, with the environment? The bond market usually thinks about risk a lot harder than the equity market.
You normally find problems problems.
I think as a bond investor, you've got a capped upside, and you don't really have to think about the upside in some ways, as long as the company doesn't default. You can have special situations where, fine, you're buying pennies in a pound or cents in a dollar, but ultimately, as a bond manager, all you're thinking about is risk.
Am I going to get my money back?
Correct.
And that's in real and nominal terms as well. So you have to think about the inflation side.
Whereas equity investors have to think about, or we do think about the upside a lot more.
Talking of upside and equities, this is neatly onto my next chart 9, Alex. So the first 6 months of the year, global equities, we said, were up 13 or 14% in the first 6 months of the year. In terms of the regional variation, we've already mentioned the UK up 7.1%, Europe up 10.4%, the US up 11.6%. So those are the three laggards. The two leaders, Japan at 17.5%, and the the first place goes to emerging markets, which are up 25.7% in the first 6 months of the year. It's okay, isn't it?
If we annualise that, would be great.
If you annualise that, another 25% in the second 6 months of the year would be okay.
And what's all that been driven by, Jonathan?
Well, before we come to that, let's just split out emerging markets, because there is a story in itself in emerging markets. So if we come to slide 10, emerging markets are made up obviously of a number of different countries, and those countries are often quite different in terms of their makeup and their stock market. This chart here, we've got Korea in blue, which is up 135%, i.e. it's more than doubled. And then you've got Taiwan, which is up 65%, which is basically just one company. And then on the loser side of things, you've got Brazil up only 4.5%, India down 5%, and MSCI China down 15%. So extraordinary dichotomy there.
This explains really where the tech trade is at the moment. So India has a lot of tech businesses, but they are more servicing and almost on the losing side of AI.
What's that? Outsourcing software.
Exactly. Which, ultimately that's where jobs are at risk. The other point is India had performed very well, and
it was very expensive.
It's very expensive when we entered the year. And then on the other side, you've got the memory stocks in Korea. You've got Taiwan Semiconductor, obviously, in Taiwan, and they're at the moment the big beneficiaries of the AI rollout.
So there are 3 stocks in the emerging markets index that make up a third of the index. Taiwan Semiconductor makes up 15% of the index.
Yeah.
And then the 2 big Korean memory names, Samsung and SK Hynix, make up another 15 between them. And those stocks have all gone pretty much ballistic.
Yeah.
So those 3 stocks lie at the heart of the overall emerging market story so far this year.
And the other thing to say is that share price performance has been driven by earnings, not by multiple expansion.
Correct.
So the earnings that are coming in and the upgrades have just been massive in terms of the memory requirement that's been required by the industry.
I don't have the price of memory has gone up something like 6-fold. It's DRAM.
Do you know
what?
I wish I don't know actually.
Should have had our resident tech analyst in.
But
it's up a lot.
It is, and the reason there hasn't been multiple expansion is because these industries are cyclical. And the expectation is that obviously these earnings can't keep growing at the same rate. So the earning, I think Samsung's on, is it still on 5 or 6 times?
Maybe 7 or 8 now, but single digit.
So still very cheap.
Yep. And then just within tech itself, tech makes up a quarter of the global equity market, is that right? This chart here I did, the yellow line is the semiconductor index, so Taiwan Semi would be part of that, but also Nvidia, also AMD, Micron, etc. That's just doubled year to date, so that's up 102%. And then on the flip side, you've got the software sector. This is the software ETF, which is IGV, I think is the index, is the ETF. So that is the blue line, that is down 10.5%. And then the Magnificent 7 as a whole, which is represented by the Round Hill Magnificent 7 ETF. The Mag 7 are down 6% year to date.
I like this chart a lot.
It's incredible.
All we've spoken about is how it's been very difficult for active managers to outperform because the Mag 7 has been so dominant. And you've had a total reversal in that performance, haven't you?
Mag 7 down 6% year to date, US market up 12.
Yeah, and going back to when Ben Rogoff came in, who is the manager of Polarcap Technology, he's got his biggest underweight to the Mag 7 that he's ever had within that strategy. I think it's about 16%, 15% of the fund. Yeah.
Well, there's 3 competing stories here. The Mag 7 are the ones who are writing the checks to build the data centers. The semiconductors, the yellow line, are the ones that are receiving the revenues from those checks. And then you've got the software sector, the grey line, that's basically losing to the AI services in theory. So whether that's Intuit, I think, has been the biggest negative contributor to the S&P this year. Obviously, a tax and accounting software, you can get your Claude to do that for you, apparently. So at least that's the story. So there's sort of this three lines in this chart, 3 stories, all sort of interconnected within tech itself. So,
and I guess that's another reason actually why the UK market has underperformed. It's not underperformed, but why it's had a soggy few months. We've got some relatively large names that are on the losing side of AI. So that'd be RELX and Experian, London Stock Exchange to a lesser extent, but concerns over their position and how it could be disrupted by AI, which I think is a more difficult story, but certainly with RELX and Experian, they need to prove themselves.
Well, they're guilty now until proven innocent.
They are. That's the tricky thing. And how do you prove yourself? The only way they can do it is to continue with the same earnings, but that's not going to be proven in, a quarter or a half or a year.
2 or 3 years.
It'll take a long time.
Yeah. Which is, anyway, but I guess the flip side of that is that a lot of those stocks in the firing line of AI disruption were already on very elevated multiples. These were still stocks on 25, 30 times earnings. Yeah. Well, they're now on 15, 16 times earnings. So they're now at market multiples. Well, they could still fall further if they were genuinely being disrupted. And if the earnings didn't come in, you'd get a double whammy again.
I think we discussed the other day, Adobe's now on 3 times earnings.
Yeah, I know. When you can get ChatGPT to make a picture for you, you don't need Adobe, do you? And then back to that point about earnings growth. So I think one of the most interesting things this year has been the rate of growth of earnings growth.
Yep.
So what does that mean? Well, at the start of the year, in January, we sat here and we said that the equity market, chart 13, Alex, the equity market was expecting earnings growth in the aggregate to be about 11 or 12%.
Yep.
So, that's the blue bars, 2026. On the right-hand side, we've got MSCI All Country World. Today, the 2026 expectations for earnings growth is 28%. So it's gone from plus 12 to plus 28. And for next year, we're up to 17% growth as well. And then the rest of the bars are split out the sectors. And obviously the one that jumps out will be IT plus 76%, which is, of course, is the AI hyperscaler memory story. And obviously a big contribution from energy, up 54% because the oil price has gone up. But I think the other encouraging bits on this chart are industrials on the left, consumer 16%
Yeah, I was just
growth.
about to point out
Consumer discretionary 28, and materials again is very cyclical, chemicals and all that sort of stuff, plus 54. So the cyclical areas of the equity market that are reliant on the economy doing okay, when the economy does well, those sectors and their earnings do quite well. You'd expect the likes of healthcare and consumer staples to put up and utilities to put up pretty mediocre earnings growth. But
well, I think, highlighting healthcare here, where we're expecting 17% growth next year, that's off the cheapest relative valuation of something like the last 20 years. Healthcare is totally unloved. I think there's some quite interesting sector opportunities appearing, actually.
So GLP-1s or slightly wider?
Slightly wider.
Right.
But I think, you've GLP-1s, Novo Nordisk has had a very tricky time. I think Eli's been much better. And then you've got the others, you've got Zealand Pharma and a few of the others. But I think as a sector and as a whole, there's been concerns over it, but it does look very cheap on a relative.
There we go. Hughesy's top tip, buy healthcare.
It's not a tip.
Not a tip.
Not allowed to tip.
So then that brings us on to the overall aggregate market valuation, chart 14, Alex. And because the market has gone up, but because expectations for earnings have gone up by more, the market is actually cheaper than it was on the 1st of January. So the global equity market is trading at 17.4 times today. The US market is down to 20 times from 22 times. The UK market's 13, 14 or something.
If I'd said to you the market was going to do what it's done, but the multiple was going to come down by 2 turns in the first.
Looked at you with 2 heads.
You just said wonderful.
Brilliant. So I don't know. There's no bubble when the valuation on the market has come down.
No.
The only bubble is the talk on bubbles. Like that. I thought you'd like that. I thought I'd get a giggle.
You've got that written down.
No, I used that yesterday, my media training. Yeah. So maybe the earnings are in a bubble. Maybe the memory stocks and those profits that we talked about. Maybe that's the thing that disappears.
The cyclicality of the the semi sector, and it is cyclical. It's not going to carry on forever. Those earnings clearly are, they're elevated compared to history, certainly. Hugely, but where do they settle, and what happens when shareholders of the hyperscalers, if you're a big shareholder of Microsoft and it's down, what's it down this year?
35, well, not year to date, but it's down 35, 40% from the peak.
Off its top. Questions are being asked in terms of you're investing all this money, what are the returns looking like? The answer is the returns have been awful in terms of, shareholder returns. So, when does that pressure ramp up of you need to start spending less on it? And then that's when, there's a knock-on effect of there's less spend, there's less buy on memory, on chips, et cetera. So we've got to be kind of wary of it and keep an eye on it. But at the moment,
there's no sign.
No, there's no sign.
No sign of the likes of Google stopping to write the checks. No. So on it goes. It doesn't necessarily mean that the market can carry on going up at the rate it has done, but certainly it is probably the determining factor for markets the rest of the year, I'd say. And then lastly, probably the most you've had a war in Iran, and the gold price has gone from $4,400 down to $4,000. Admittedly, it did go up to $5,000 in February. It was very strong in January and February. So this is funny if it's a gold line on this chart, and then it's come right back down. And then
I think this is the thing I'm most surprised about, actually.
Okay, yeah.
I thought there'd be a floor higher up than 4,000. I was reading some technical analysis this week, and apparently if it goes below 4,000, the next floor is 3,400, but that's a proper floor.
Right.
But as you say, with the conflict, you would usually expect a safe haven like gold, less so Bitcoin, but gold to stay relatively strong.
Yeah, and it hasn't. I mean, a lot of the weakness has come in the last month or so, and we've got a new man at the Fed. We haven't really talked much about him, Kevin Walsh, Trump appointee. So, people's priors would have been, well, if Trump appointed him, he's clearly going to angle for lower rates. His press conference last week, and I watched it, sadly, he did come and say that inflation was too high and that they need to get inflation back down, which came across as being quite hawkish. There's been some mixed messages since, but because of that, and because the US economic data has been stronger, the expectations for the US, again, as we touched on earlier, are for rate hikes, and the dollar has been stronger. So in an environment of a stronger dollar, and if gold is sort of this, if money holds its value because inflation's low, you don't need to own gold. People want to own gold when they think that their fiat, to use that nasty phrase, is worth less because of inflation and debasement. Well, and that story's sort of disappeared for the time being. Maybe the same could be said for Bitcoin, which has gone from, $100,000 at the start of the year, $90,000 down to 55,000, 58,000.
Yeah.
It's been whacked, isn't it? There's a sort of...
there's also some selling pressure on that from things like I'm not sure if MicroStrategy has been selling Bitcoin yet, but there's a lot of worry about it, isn't there? That they're going to have to stay liquid.
Yeah. We don't need to get into the MicroStrategy story, but it's an interesting one. But yes, certainly. So you've got a bull market in equities, you've got a bull market in the tech sector, yet Bitcoin's down, and that's unusual because traditionally it's
been a risk asset
with the Nasdaq, isn't it?
Yeah.
So that's been that's been a story. So those are all my charts. It's been entertaining. Has it been entertaining? Volatile, stressful. There's some quite long days in March and April. But broadly, for those clients who are invested, diversified, well diversified, because you did need to own the relatively small number of winners.
Yep.
If you didn't own much of emerging markets and much of the US semiconductor sector, your results look pretty horrible. But most balanced portfolios, whatever that's worth, are up 8-9%.
Yeah,
pretty good, particularly off the back of a good year last year.
I would definitely have taken that. I think the environment is more problematic than we'd like, but I think we always say that there's always something going on.
Top tips for the next 6 months?
Healthcare,
apart from healthcare.
Stay diversified.
We're still overweight equities. There's nothing out there that. There's lots of things out there that could happen, but
I think on a serious point, earnings drive share prices. We've got very good earnings growth expected. Valuations have come down. Employment, as we've highlighted, or unemployment levels look fine. We'd like better growth. The UK isn't growing as quickly as we'd like, but the US, as you've just said, in terms of retail sales and where the consumer sits, that looks relatively healthy.
Yep.
So, we'd expect companies to keep doing what they're doing.
Yeah,
I think trying to predict the next big economic event or crisis is impossible. Stay invested in great businesses that, as we've already said, are probably better at being flexible and maneuvering supply chains,
dealing with
customer base. Exactly, they're getting much better at it.
Yeah, agreed. And the flip side from a portfolio perspective, I guess, is just to make sure that you've always got some dry powder available. You're not all in. If you're all in on one theme, then you are very at risk.
I wouldn't be all in on a 3 times leveraged semiconductor index at this point.
You don't own that.
No, I missed that in the pension, sadly.
Can't believe it, easy.
But at the same time, I wouldn't be selling these companies. They're great businesses, and their earnings power is incredible. They've got, in some cases monopolies, if not oligopolies. It's, they're not going to go. They're not going to fall over overnight. It's just a case of where the demand comes from, and that is a constant concern. And it's what people are writing a lot about and spend hours and hours thinking about. But ultimately, when it happens, no one can predict it. It'll be too late.
Agreed.
But you just need to make sure the position size is correct, which is what we do through the portfolios.
Yeah, I mean, I often think a lot of our job is quite monotonous in the sense that we have to find different ways of saying the same things. Stay diversified, be disciplined, make sure you're not over-invested, make sure you're in all the right areas.
I say way more interesting things to my clients.
Do you?
Yeah.
Go on then.
Holidays?
I get it. Oh dear. Well, plenty to talk about with you, isn't there? How many holidays have you had this year so far?
It's my third.
This is your third.
I think
not too
so.
bad. You're skiing Girona and now Cyprus.
Cyprus, yeah.
Right. Okay.
Well, what about your holidays?
We're going to Cornwall in August, so not anywhere near as glamorous.
It's probably Cyprus is probably cheaper than Cornwall.
Possibly. Yes, I would hesitate.
The water's not quite as warm.
No.
Well, not in Cornwall.
I've got one night golf trip.
Have you?
Playing Royal Birkdale, which hosts the Open.
Very nice.
So Birkdale hosts the Open in 2 weeks' time, and we're playing it 2 weeks after that. So it'll be hopefully in mint condition.
Very good.
And that's pretty much. We're going to Turkey, but not until half term in October.
Oh, nice.
Mm-hmm. So that's
there you are. You've got plenty to talk about.
Yeah, it was fine, isn't it? But there we go. We didn't get to go on our Australia trip in March, April.
Did you watch the England game last night?
Yeah, did watch the England game last night.
With George?
No, George was at home. I was here. I watched it in town.
Did you?
George was very excited though, because obviously it's the first game he got to watch.
Yeah.
I did sort of mention to my wife last night. I was like, the next game's on Sunday night at 1 a.m. Do you think we can stay up for that?
Well, we're as I've said, we're in Cyprus and they're 2 hours ahead, so it'll be 3 a.m. for us. So there's no chance.
You can go to bed and get up, I suppose.
Could do. Charlie's watched a couple of first halves, but it's a shame because of the time difference. Because it's actually the tournament's great. The stadiums are amazing.
Well, as I keep saying, we all remember our first World Cup. I mean, I remember Italia 90, and I remember staying up to watch the West Germany game when Gaza got booked and cried and we lost.
Was that when Roberto Baggio missed the penalty? Hit it over the bar.
That was
the next one.
That was the next one. US 94.
I do remember Gaza crying.
Yeah, seminal moment. Yeah. So we'll call it a day there, I think. Is there anything else? Any other final parting thoughts?
That was, good 6 months.
Good 6 months. Here's to the next. Fingers crossed.
Another 8% for the next.
Well, it's a bit less volatile. I mean, I'd fancy any more wars. But thank you very much to everyone for watching and listening today. Hopefully that was of some use. Email me, jonathan.raymond@quiltachievia.com. You can email Hughesy if you like, james.hughes@quiltachievia.com. But we hope to see you next time. And until then, thanks very much.